Ladies and gentlemen, good morning. So welcome to today's session on the dynamic realm of electronic trading, particularly focusing on the landscape in South Africa. I was asked to set the scene a few moments ago, so I scribbled some notes. So mind me as I talk through this, or read through this. As we navigate through the intricacies of modern finance, it's essential to recognize the pivotal role that electronic trading plays in shaping markets worldwide. And South Africa is no exception. In recent years, we've experienced significant evolution in the electronic trading ecosystem, driven by platform advancements, regulatory changes, and the shifting of market dynamics, with new exchanges and dark pools coming to markets. We've seen several new OMS and EMS platforms, algorithmic trading and high-frequency trading firms, and JSE Colocation 2.0 launched just last year. And the landscape has become increasingly sophisticated and interconnected. However, along with these opportunities comes challenges. Issues such as cybersecurity threats, increased market volatility and systemic risk, complicated connectivity methods, and regulatory compliance that has fallen behind, yet continues to shape our landscape. Moreover, underscoring the importance of robust risk management frameworks and advanced regulatory oversight. I'm Merlin Rajah. I'm head of Equities electronic product, and I have the pleasure of being part of this fireside chat with Mike Powell, the CEO of Rapid Addition, and Andrew Cairns, the head of Prime Services at Standard Bank Group. Mike, Andrew, welcome.
Thank you very much.
Thanks, Merlin.
So, Absa and Standard Bank are pretty household names here, Mike. So I'd really like to give you 2 minutes just to talk to everybody about what does Rapid Addition do and a little bit about yourself.
You say no one's ever heard it. No, so hi everybody. Great to be back down in Cape Town, particularly as it's February in London at the moment, where I'm normally based. So it was a hard call to be persuaded to come down here. But so my name's Mike Powell, CEO of Rapid Addition. We're a trading technology company. We work with clients such as the guys up here on stage. We've been down in South Africa about 10 plus years. But it's a global company effectively providing a trading platform technology to allow our clients to define and build their own kind of electronic trading workflow and plug into their broader trading ecosystem. So it's very much around A, enabling electronic trading workflow, but B, actually putting the control in the client's hands so you can build competitive differentiation and inject your IP into your platform.
Thanks, Mike. So I know not everybody here is market structure experts or electronic trading experts, and some of the topics we're really going to delve into has some common themes across it. So I'd really like pretty much 4 terms to just really be defined as we go through this panel. And, I'd like to start with you, Andrew. If you can just cover what is sponsored access, that's come up quite often. And if you can also cover remote membership as well.
Sure. So access to the exchange comes in multiple forms. The term sponsored access is often interpreted differently, but basically sponsored access is a solution whereby a broker will give a firm access to the exchange through their connectivity and membership, where they connect directly under their membership and access the exchange. The difference being is that in a sponsored access solution, the exchange monitors the risks and has the risk monitoring solutions to be able to monitor to that. The broker doesn't do that.
Yeah.
Remote access is whereby an independent firm outside of the broking community will take membership to the exchange and then appoint a clearer. So in the European space, they're called non-clearing members, and they get access to the exchange through their own memberships, and that's cleared through one of the big banks.
Yeah, I think that's a good one, right? So remote membership has come up a few times. Should we unlock that? Should firms, globally just be allowed without having physical presence in South Africa to become members? I think, Mike, you brought us something when we last chat. You said, is this community really overbroked?
Yeah, it's an interesting question. It's an interesting question, right? So I think, like many markets, it's great to have competition, but how big is the size of the pie? Is there enough to go around already? And actually, are bringing more sell-side participants into the market a good thing, or are we already overbroked? And should the focus be a little bit more on kind of increasing the size of the pie through improved liquidity, improved listings, and so on? And maybe some things we can touch on later. But yeah, I think before doing that, there are quite a few considerations. A, are we overbroked already? And then B, the impact on people who have committed to being on the ground members of the exchange, the jobs that creates, not just the trading desk, but all the peripheral services, be that the sort of middle and back office guys, the consultants, the technology firms, the accountancy firms that support that ecosystem. So it's one would need to think carefully around what's the unintended consequences of doing something like that.
Yeah, 100%. Mike, the other two, themes that come across often as well, I'd like you to cover this, is DMA. It's pretty common, direct market access. Can you define what DMA is? And then the other one is, what's the difference between DMA and naked access that's also come?
Yeah, I'll try my best. I think as Andrew touched on, there's a few nuances around this space, and sometimes it's quite difficult to actually put very hard and fast definitions around this. I think everyone here is obviously very familiar with the traditional transaction. Asset manager sends an order through a registered broker who's a member on the exchange. It goes through the OMS. They're either going to then, high touch work that order. You get a parent order in, and then you break that down into child orders to execute it on an exchange, or potentially put it through algos, and it's low touch, right? That's all through the registered broker. DMA is a broader term for certain types of clients whose maybe their business model is based on latency. There may be more sophisticated clients who want to deploy their own algos, for instance, and it's effectively using the membership's ID to trade on an exchange or a venue, right? So that's the sort of general term, direct market access, under which things like sponsored access potentially sit, right? Naked access in that context is where you're enabling a client, a non-member client, to use your access to market, either through their own infrastructure or potentially your pipes, but they don't have the pre-trade risk checks in place, because potentially that adds latency. So there's a trade-off, right? So it's this, how far do you go in supporting that business model? And then what are, again, we talked about unintended consequences of that going forward, and what risks are you implementing? So maybe that's something we can expand on.
Yeah, I mean, that's a good one, right? So Andrew, why would a broker go through that riskiness, if I call it that, of bringing on a quant client, not putting proper pre-trade risk validation, and allowing them to trade in the market?
Yeah, so I mean, it's a very interesting topic, and it's quite topical in terms of the new JSE rules that have come out. But we think that pure naked access in its purest form brings some systemic risk to the market, and obviously that's what the JSE sought to regulate in terms of how people access the exchange. So I think these type of things are always a consultation process, and in the interest of getting a level playing field, an environment where everyone can access it seamlessly, but ensuring that the risks are mitigated and managed adequately.
Yeah, I was going to touch on that a bit later, but since we've gone into it, let's go into it, right? So the new JSE rules are still in its informal stages, yet to be through a formal consultation, and that's going to start really soon. And that really is going to define what pre-trade risk filters a broker needs to have before allowing, quant funds, hedge funds, HFT firms to trade through them. And it's something that, I believe should have been looked at quite a long time. The US and Europe kind of banned naked access in 2010. Unfortunately, the JSE rules just never caught up to where it should be, right? The new rules, though, basically state the member needs to have a whole lot of pre-trade risk filters. You can't just have a physical switch, a kill switch. You can't say you've worked with the client on a solution and it's embedded in their algo. You can't say it's on swap, so it's technically my order. It's quite direct, and it's quite, precise. Do you think this is just too onerous, or what do you think the regulators really thinking about when they wrote this? Mike, maybe you wanna?
Yeah, it's always a challenge, right? Because I think, innovation's important, competition's important. We need to keep financial markets moving forward. I'm a huge believer in efficient capital markets make the world go round. I know bankers all get a bad press in the general media, but it's important. What this industry does, right? So having said that, one always needs to tread carefully. So there's lots of well-known blow-ups and flash crashes and things that we can all refer back to. So that can be the impact if it's not defined fairly stringently.
Yeah.
I guess it's not exactly a direct market access because Knight Capital was a member broker, but actually if you look at the Knight Capital, most of you probably heard of that. Where effectively they, through placing orders for an algorithm that went a bit haywire and the robust risk mitigation wasn't in place, they lost $440 million in less than 45 minutes. Yeah. And effectively that was the end of Knight Capital, which up until that point had been a very kind of dynamic, progressive firm. So I think it is important that when regulators come out, they are very clear in what it is that they're proposing. I had the joy in a prior life when I was at, it's LSEG now, but was Thomson Reuters at the time. I was the executive sponsor for MiFID, one of the many joys of my career. And so I had to read these sort of, vast volumes of consultation papers. And I think just the amount of effort and angst that went into trying to interpret what the regulators were trying to achieve and how that manifested itself in actual operational deployment of process and systems. At times there could have been better clarity. And I think perhaps why MiFID has achieved some great things, but not necessarily all the things that it wanted to achieve. So for instance, we're still talking about consolidated tape multi years later. Yeah. So long answer to your question, but in general, I think if you're going to bring regulation to market, it needs to be clear. It needs to be definitive, and it needs to create a level playing field for the market that everyone understands and it interprets it in the same way. Yeah. And perhaps that hasn't quite been where we are, where maybe it was slightly higher level and maybe different firms have interpreted in different ways up until this point.
Merlin, I know some of the suggestions in the market have been like a sponsored access solution. Yeah. Any views on whether you think it'll work in the local market and whether it's a viable solution? Be interesting to debate that topic.
Yeah, so sponsored access has come up quite often, right? Many markets have gone to sponsored access. So originally, quant firms used to trade through a broker, and then they found out about, they wanted faster latency, so they built their own risk mitigations within their platforms. And then the regulator came out and said, well, that's not allowed anymore. You have to go to an independent risk layer. And then further to that, sponsored access came out where you could put the risk layers directly onto an exchange. So that definitely could be a viable solution in South Africa.
It's a big responsibility for a venue, for an exchange to implement their own risk and controls, right? Rather than put that responsibility back on the brokers, right? Because ultimately, they're bringing that trading to market. How they do that needs to be done in a sensible way. I've heard people talk about, but there's circuit breakers, kill switches. I think that's nuclear, right? Yeah. That's like the last resort because it's hugely disruptive for the market. Impacts everyone else. So one person makes a mistake, the whole market gets impacted if there's a circuit breaker, or even on one stock because it's probably going to be a liquid stock. And secondly, it's reputational damage for the market. South Africa, like all markets, is competing for capital on the global stage. And if you're an institutional investor and you're going, geez, these guys have had a few kind of like they pulled the curtains down middle of trading and left people exposed, it's not a good look, right? So I think it's important to have those mitigated controls, but there should be a lot more in front of that before you would ever have to use that.
Yeah, I was also on a call when somebody stated, well, there's circuit breakers in place, right? So 4%, we'll stop it, we'll pull the client out. But like you're saying, 4%, when the market's moved, it's too late, right? You've lost money, everybody else has lost money. And then that's only on ZAO1, because clearly the person who was saying it didn't realize the circuit breakers are different on ZAO2 and ZAO3. you're talking about 20-50%, right? When they start trading ETFs, etc. So you could blow your bank out if you're not properly looking at your risk mitigations. I think let's go on from that, right? So Andrew, you guys are a big bank in this market. You have a variety of different types of clients. What are some of the tools and systems you need to have to support, the types of business that you have? Without naming the specific vendors, what do you guys need?
Yeah, I mean, Standard Bank embarked on a journey from 2016 onwards to evolve our infrastructure and capabilities in line with global best practice and best standards. And we have embarked on journeys with a number of the international vendors to come up with solutions to support multiple facets of business, everything from the low latency solutions for systematic trading houses and proprietary trading houses, just random, retail clients that want to trade using algos. We've invested a lot in that space. We've invested a lot in new OMSs and EMSs in our fixed hubs. So we've gone a long way down that journey in terms of spending the money to be able to support all the different clients that we support. I think as one of the biggest brokers, we have everyone from very basic retail investors who are trading once a month, twice a month, to the most sophisticated. So we have a very large array of vending solutions and capabilities to try to cater to all that. I think the challenge for the broader broker community is not all of them can spend that type of money. So as a broker, one of the big brokers, we are looking at avenues like the SIP, where we share infrastructure to be able to support the smaller brokers. So we're thinking of ways of trying to expand our market, increasing the liquidity, finding solutions for the investor community much broader than just our own. And I think that's one of the sort of key components of being a big broker in the market is, we have to try to grow this market. So how do we do that?
Yeah, it's quite interesting. If you don't mind me commenting from looking in from the outside, I really like the kind of approach that you and your team are taking. Quite like, you talked about your different client types all the way through from retail to some pretty sophisticated international high frequency guys, but looking at that in a very kind of integrated technology stack way to sort of build that sort of solid foundation that gives you the agility to respond to different client needs, but then look at kind of intelligent ways of having built that. How do we leverage that going forward?
Yeah, I think it's a really important part of what the evolution of the broking community in South Africa is, that we actually need to support each other. And I think one of the key themes that came out earlier was collaborate. And we're very much in that space. And how do we collaborate to grow our market?
I do see a question here, and maybe Andrew, if you want to try and tackle.
Yeah, so the question is, doesn't sponsored access stop brokers competing around their risk control and appetite? It introduces a one-size-fits-all risk model, which stifles competition. So, I mean, ultimately, a sponsored access solution will mean that a client can connect, and then the broker would have to compete on financing balances or find another avenue to compete. Yeah. So, yes, it probably does, but there are other ways of competing. We compete with the ability to fund and your balance sheet.
Service, etc.
And service, yeah.
And service. But, there's multiple ways to actually implement sponsored access, right? Does it mean all of your brokers need to go through a sponsored access layer? Or if you have your own FPGA risk layer, it can go alongside a sponsored access solution. So if I had a client who wants to use sponsored access, they can use it. Or if I have a client who doesn't want to use sponsored access, they could use my FPGA risk control, for various reasons. And I mean, that's where the South African market needs to go. It's a journey. We're going to have to debate these questions that come up, but it's a really good question. Thank you for that.
I think the other thing, just touching on, you talked to Andrew about the kind of tools that are required. I think one of the key things as well is when you're making those investments, are you looking down the track, particularly with the regulatory change that looks like coming? So we're talking around some of the proposals around sponsored access, DMA, and so on. But then there's also, we touched on this at the conference last year, things like best execution is being debated at the moment. And do you implement something along the lines of MiFID, which is quite multifaceted? So it's not just price, it's cost, it's latency, it's ease of settlement, etc. There's a whole combination, and the onus is on the broker to effectively get the best outcome for the client. Or is there some other more localized definition of that for what impacts the market? Now, where you need to be a little bit careful is the things you're putting in place today are, will they be fit for purpose down the track? So I'll slightly talk my own book here, but just to sort of to make the point, we're very much kind of like highly configurable technology. So if you're looking at building like a smart order router, obviously initially you'll be looking at, okay, we've now got competing liquidity venues in South Africa. So I've received an order, as a broker, am I getting a better price at that initial size on, one of the two venues, right? So I execute that bit. It needs to be smart enough to say, okay, then the next best price or the next bit of volume is on the other exchange. Okay, so that's fine. That's what you'd expect. But, when you need to start layering things like exchange fees and latency and size and all these other components that might make up best execution, can you implement that smarts into your smart order router? Is it really a smart order router that you can make that adaptation to be ready to meet those obligations as they come to market in the new regulations? It's the same with the FPGA risk filters that we provide. Have you got that full audit trail of change and everything you implement on that? Because from the documentation I've seen, it's not just have you got that in place, there's a whole lot of sort of operational process stuff behind that as well. So I think, people do need to think around what they're dealing with now, but also what may be coming down the track, and how do you keep a little bit of flexibility around your infrastructure.
I think you touched on some really good points there, right? So the smart order router, best execution, Andrew, from that perspective, when you guys look at smart order routing, to other exchanges, the market's changed, right? The other exchanges are growing. When you configure your smart order routers, what do you think about when you'll implement it?
I think Mike touched on it. We've been very deliberate around every investment we make. We make sure it is future proof. So we make sure that if internalized or smart order routers, dark pools of liquidity, we're able to configure our capabilities to be able to match that. So in that tech spend, we were very, very conscious around, is it fit for purpose, and then does it future-proof our business? So it's all those considerations that have come into play. The great thing is, the vendors out there, we tend to lag Europe, and the vendors out there that we have partnered with have all had configurable solutions to be able to support those type of those complexities as they roll them out. So yes, it does bring complexity, but I think it's very important to choose vendors who are flexible enough to be able to support them.
Yeah, and I mean, the demand is there, right? So you're seeing that from local and international clients who are saying, well, if you don't give me best execution, then we've got a problem, right? If my other broker is giving me better pricing because they can execute in other pools of liquidity, not only just the other exchanges, the other dark pools, etc., then, unfortunately, you're not going to be on our list. So it's going to become increasingly more complex for everybody in this market, not just the top big players, to be honest.
Yeah, I mean, there was an interesting comment. I think it was from one of the guys, traders at Investec last year, that said, we all compete on execution anyway. So absolutely, of course you do, right? I mean, it's a competitive market. But it comes back to level playing field of what that definition is, and then also allowing the asset managers to be able to sort of benchmark that. I guess, again, unintended consequences or intended consequences. One of the things we've seen with MiFID in Europe certainly is the requirement on the buy side now to actually be able to rank their brokers and have those tools, like TCA and so on. It's about market maturity and getting the balance between how do we create, efficient, fair capital markets, but also not implement so much cost and operational overhead on people that it sinks them, right? And I think getting that balance is right. I mean, remember, if I think back to original MiFID 1 in Europe and the amount of market fragmentation and the growth of all these new MTFs, there was too much, right? And a lot of that's got consolidated, but people were chasing the tail to connect to these new venues that ended up not lasting or getting absorbed up back in, like Turquoise was bought by, LSE, Bats being acquired and so on. There's names like Burgundy and stuff you probably don't even remember, but there was a lot of over fragmentation. So I don't think that's ever going to happen in somewhere like South Africa, but it's that balance between efficiency, vibrant market, fair market, and what's the overhead and onus you put on people, and is that realistic within their business model and within the overall volume and commission generation of the market?
No, I think that's very important, Mike. When you say over fragmentation, there's a possibility, right? So you have Liquidnet as a dark pool, you have multiple exchanges, you have a few brokers partnering with dark pools, you have the JSE looking at implementing a block matching mechanism, right? All of these things take away from the central order book. So you got to be very deliberate when you come with a strategy as an exchange on what do you want. Do you want to ensure that you have more block matching and you're going to may possibly dry up liquidity in the central order book, or do you want to stimulate the central order book, by bringing in different types of clients? I think that's very important. But what really we've seen, I was on a trip to India last year, and it was a great trip, seeing a lot of clients. And what came out of that was the retail market in India has just exploded. Everybody's trading. They trade sophisticated options, futures, etc. And this happened during COVID, where everybody was sitting at home, had nothing to do, registered an account and started trading. And now that market trades $10.5 billion a day. On the equity market, to put that into perspective, the JSE trades $1.5 billion a day. And the derivative markets are multiples of the equity market. So it's absolutely massive, and it's booming there. And when I asked the question, I said, how did you get this right? And they said, market data is free, it's low cost to execute, etc., etc. What do you guys think is, what's been the inhibitor for retail trading?
The cost is always an inhibitor, and I think we've embarked on a lot of dialogue with the JSE in terms of trying to find avenues for increasing mass market participation. We have a deliberate retail strategy within Standard Bank to try increase what we call a new investor and get people interested, and the retail clients interested in coming back into our market. I think the challenge is they can go and open an account and trade crypto in a few minutes, whereas trading in equity is much more onerous. Onboarding's onerous, the costs are onerous, whereas it's trading in FX or crypto is much easier. So I think if we can find avenues of bringing the retail and mass market back, and get them to stimulate some additional liquidity, that would go a long way to bringing additional liquidity and capital back onto the exchange.
Yeah, it's really interesting, the whole retail question. Some markets obviously much more retail dominant than others, and bring that flow in.
Yeah.
Particularly with better technology these days, that's more, it's easier to do. But I mean, if you look at, you talked on India, that's somewhere between 25 to 40% on any given day of overall retail flow. In the States, it's about 25%. In South Africa, it's sub 10%. Interestingly, Australia is smaller. I was trying to look at comparable markets, but I think you're at the point now. I saw some stats recently that more people own crypto than have a share dealing account. So it's kind of interesting, because if you look at retail, it's like, we have to protect the end investor. Do they know what they're doing? And the sort of all these sort of checks and to sort of set up broking accounts. But that same person can within 2 minutes be trading crypto on their phone. Yeah. So how much are you really protecting them? Yes, you want to be sensible about it, but you don't want to put up so many barriers, because there's competition now. It's I'm on an advisory board for a digital assets organization, and not a power company. Is this still working?
It's still working.
Yeah, great. It's just you're gone dark, but and not because I know I'm not a crypto guy. I don't know what's about that, but interesting. This company is looking to bridge between DeFi and traditional capital markets, right? So doing a lot of the kind of integration, working with Swift and DTCC, and you're seeing all the big banks now are running private chain initiatives, things like tokenization of deposit accounts and so on. So it's coming fast. And I think we need to be a little bit careful, particularly around the retail space, of the exciting products, the ease of access, the cost of trading, compared to if I want to set up an online broker account.
Yeah.
And it's just the sort of younger generation gamification. They like this stuff. They're growing up, sort of making investments in crypto and so on. And there's a danger that maybe we miss out on that capital coming into markets that actually provide capital for the real economy.
Yeah.
Rather than just sort of trading digital assets, and some good, some bad, right?
Yeah. Probably I wasn't going to mention this, but I spoke to somebody senior in the market and I said, we need to do something about the retail market. And they went, there's a tiny retail market. The retail market that has money, they're not so sophisticated. They don't understand this. And I went, well, that wasn't the case with crypto. Everybody could trade crypto. They knew how to do fractions. They knew how to transfer Bitcoin abroad. If you look at Cape Town, there's a massive crypto exchange that has a big sign and a big building. So, that can't be the case.
Yeah.
We really need to get this right. The last part, I really want to just touch on is the commodity market, right? We're seeing, I think there's massive potential in that market. Unfortunately, it just hasn't come through with the ITAC 2 that we, all were waiting for. And we don't know when it's come back. I mean, Adu, do you see demand? Do you think that could be...
We have had the odd conversation. I think what we do see is clients, when they are looking to hedge in the commodity market, they're traditionally using offshore listed product. So we need to find ways of getting that back onto our local exchange and stimulating some demand in terms of liquidity in that market. So always open to ideas, but we do see predominantly stuff going offshore.
That leads into another interesting conversation. We're talking about growing liquidity, this whole issue of like listings, right?
Yeah.
And how, and it's not just a South Africa problem. I was sort of doing a bit of background reading for this, and I think like London market, like listings have declined 40% since 2008.
Yeah.
So there's multiple factors in that, but the sort of cost and complexity is definitely one, but it's things like analyst coverage. So it's a bit of a segue from your commodities. I mean, what's South Africa well known for? Sort of mining companies, mineral, etc. Is it, maybe it's not like a tech giant like the West Coast of America. So what Europe is seeing is losing potential listings out to going on NASDAQ, for instance, for international tech firms that might be based in the EU. So thinking of the sort of strategy to attract, why should someone list, and B, removing the barriers, because going back to the digital assets thing, there's a lot of talk now around. So if you look at the last 10 years, we've had virtually free money, like zero interest rates. VC market was massive. So pre joining Rapid Addition, I was chairing an advisory board for a startup on the Barclays incubator in London, and this whole world of people just raising funds, and no one was talking about listing. It was all like, we can get this money, we need capital, we get it. They're not thinking about going on the AIM market in London, for instance. So that kind of distracted people from potentially listing, and they were doing series C, D, E, F when previously they might have listed. That's gone away now because interest rates gone back up. That money's sort of tightened up. But what I'm starting to see is a lot of discussion around private companies saying, well, let's do tokenization to raise capital and come to market rather than go on an exchange. So again, we need to be a little bit careful because the world's sort of changing under our feet, and it's a bit of a global problem of how do we encourage more listings, because then the market it's a bigger pie, it's more dynamic, there's more interesting products. You can generate derivative products and so on. But if, ultimately, if people aren't listing, your market's shrinking, right? So.
Yeah. And doing that?
Yeah, I mean, primary markets are, a cornerstone of the economy and raising capital. And, we need to find ways of making it less onerous to list. I mean, I think that came up earlier in some of the other discussions, but making it attractive for companies to list is a very core component of building our liquidity and the ability for us to grow.
There's a question here. Mike, do you want to take this question?
Let me read it if I can. Broker overheads seem to increase considerably as buy side starts to look for liquidity and efficiency, but broker industry commissions and fees seem to be at a race to zero. a global issue. What do you see for the future of the industry, especially with the introduction of new tech and AI? Yeah, it's a tough one, right? I mean, as you guys aren't the only one seeing that. It's a common refrain on the sell side. I do think there are inherent advantages of, comes back to this remote listing, having on the ground brokers in markets that are offshore for the major investors, and looking into that market, having that expertise on the ground. How do you navigate those markets? I was at a conference out in Singapore last October. I try and find warm country conferences in cold times of the year, you know. So, and it was really interesting because it kind of reinvigorated my sort of faith in the value of the sell side. That actually, if you look at the ASEAN market, so the Singapores, Philippines, Indonesia, they've all got different rules, regulations. It's complex, and actually having the local sell-side broker with that market knowledge to help you navigate it, there's real value in that. And yeah, you guys are Pan-African, so you could provide the same kind of advantages here. Yeah. So I think it's important to have a vibrant sell-side community. I think tech just has to. You've got to make that investment and then create the efficiencies. So if you look at what Andrew is driving at Standard Bank around this effectively a common platform across the whole client, different client segments to create efficiencies. AI is interesting, and I'm certainly no expert on that. I think we have to be very careful with AI. Not in terms of I'm not particularly worried that the Terminator is going to turn up in Cape Town tomorrow, but more from like just the veracity of where that's coming from, and the traceability. So people starting to use AI for like trading and algos and stuff. I think one has to be very careful, but there are efficiencies it can bring. We're starting to look at it from, can we leverage that for like automating rules of engagement to make onboarding easier and so on, right? So I think it's around leveraging tech as best we can to drive efficiencies. Really understanding the value that individual firms brings to the markets. If you're a broker, what's your speciality? And unfortunately, you have to be pretty ruthless around your clients. And right, it's like these guys are profitable, these aren't. Maybe someone else can make them profitable. I don't know, but
spot on. I mean, that's what we do at Absa, right? We interrogate the data. We look at clients' average trade sizes. Are they making you money? Are they losing money? You got to look at the value across the value chain, and having proper data embedded in a nice platform where you can extract this and analyze it is really key. And I think that's going to be the future. Andrew?
Yeah, I mean, we've the pressure on fees is not new to the broker community. I mean, it's a long road over the last 10 years. We've all had to evolve and adjust our business models to become more efficient and remain profitable. The race to zero is real. I mean, we have low latency clients coming in and saying, let's do this at cost, we want to do this at cost, and we price takers. So we have to find other avenues of making money off them. Financing is obviously an avenue, and I think having to look at a client holistically is an important component, execution plus the funding piece, but you can't do that with every client, right? So it is a real challenge, and we continue trying to evolve our business to adapt. Ultimately, it comes down to efficiencies, where you're making markets and liquidity provision and market making and those type of things. It's one of the avenues, but it is real and it's tough.
Yeah. So we got literally a few minutes left. So let's close it up with a closing remark. I think, Mike, is there anything you want to say before we close this session?
No pressure. Yeah, look, I think markets continue to evolve. I think clarity from regulators. It's great to see the consultations going on, but when that regulation comes, it needs to be clear. It needs to enable people to innovate and compete on business differentiation, but within a robust framework, so that A, it's fair, and B, it kind of de-risks potential things of the market. So I think it will continue to evolve. As I said, I see very much the whole sort of digital assets world as enabling capital markets rather than competing. I'm not a conspiracy theorist, and some of the original kind of, crypto coin of, outside the controls of the government, not really my thing. But actually, if I look at some of the technology and how it's being deployed and the opportunities for tokenization, I think that can really enhance capital markets. So I think that's going to be an interesting trend. And then just to sort of plug from the tech side, I think we're sort of shifting away from, solutions that have been good but a bit monolithic, and you kind of buy the whole back, front to back from a vendor, to a more agile and nimble world, because the world is changing rapidly, of having more interoperable technology, plugging together best of breed rather than buying the whole stack from one solution provider, because I think those days are kind of a little bit gone, and don't allow firms to be nimble enough. So, so look, where our focus is as a firm is providing that sort of agility to go forward. So I think that'll be important going forward as well.
Thank you, Mike. Eddie?
Yeah, I think at Standard Bank, we, as one of the big brokers, we're very much in partnership mode. So, we've built a tech stack and capabilities which cater to lots of different clients, and leverage. We want to be able to leverage that to the smaller brokers in the broker community and find avenues of growing our market. So I think that's a responsibility of us as one of the big brokers, is to continue to try grow our market and find those avenues. And so, anyone out there that's looking for advice or the ability to partner with us, come and have a chat.
Yeah, I think it's important for us to share insights, right, and have these discussions, whether it's in a conference or in your committees, etc., so that we can build a market for the future, right? And we need to create a sustainable market for everybody. Just want to thank you guys for your time. Thank you guys, and can we have a round of applause for our guys? Thank you. Cheers.